James, how did the Harmony portfolios fare last month?
Well, August saw a continuation of the positive returns we saw in July. In fact, an enhancement on it. The returns were sort of better, and market conditions were reasonably benign. Volatility slightly lower volumes as well, perhaps as you would expect in August. So, with the MSCI returning 2.5% in US dollar terms, on the whole, the Harmony funds did well. The whole range provided positive absolute returns for the month. And in fact, that's the second month in a row that that's happened, which is obviously very pleasing. From a relative point of view, the majority outperformed, and the few that didn't, it was generally due again to a strong local currency impacting the translation of foreign currency returns into reporting currency.
Excellent, James. We've spoken there obviously about the currency effect. Other main drivers last month?
Well, equity markets up is always going to be the most impactful. Government bonds were also positive in US dollar terms, but within that it's important to drill down to notice that the US and the UK, big markets, sort of very stable bond markets in the government space, actually underperformed. Their value drifted off as their yields rose, whereas Europe, obviously the epicenter of this sort of positivism following Draghi's pronouncements in the month, European bonds returned positive returns, even though Germany within that actually drifted off a little bit. The peripheral yield rallying was enough to sort of subsume that. Elsewhere in the investment grade markets, the high quality parts of the corporate debt spectrum, investment grade did okay, outperformed governments with a moderate positive return. High yield also outperformed government debt, but didn't keep up with the equity market. That's roughly what you'd expect. Convertible bonds disappointed a little bit. They were positive in absolute return terms, but they didn't keep up with even the government bond market. In fact, the holding that we use. Finally, emerging market equities underperformed global equities, and in fact they posted a negative return for the month.
Interesting. As portfolio manager, did you elect to make any big changes during August?
Yeah, we've continued the evolution that we started in June to start to change how the portfolio looks slightly. We've continued to hold our underweight to equity markets. That's roughly 2% underweight in the balanced funds, 3% underweight in the growth funds. We continue to be heavily underweight global government bonds, overweight investment grade bonds, high yield strategic bonds, and convertible bonds. So while we've reduced our equity, it's still a mildly risk-on portfolio positioning. And the reason we've reduced the equity is very much on a valuation basis. Equity markets have had a strong run from the recent lows in June, and we thought it's prudent to take some of that risk off the table now. Other positions, we've increased our underweight to global listed property for the same reasons really. They're not looking particularly cheap, and they've outperformed global equities quite significantly over a reasonably prolonged period now, and I think that's due a reversal. Consequently, as a result of those trades, we've increased our equity weight. That's an active decision to do that. It's not just sort of a balancing item. We want to be higher in cash presently. We are conscious, of course, that the levels of cash are relatively high now, though. So rather than just sitting in a money market fund, we're allocating a proportion of that to an enhanced yield type of manager. It has a higher return, but still pretty low volatility. But it's slightly riskier than cash. The max drawdown on that sort of strategy is around about 4% on any given month. So it's riskier than cash, but it's not anywhere near as risky, for example, as longer duration high yield or investment grade.
You've spoken there about equities having a decent run, listed property as well. What else should investors be looking for going forwards?
Well, there's still a large number of different macro risks out there, which we need to be cautious about, whilst at the same time looking at valuation and maintaining our discipline in ensuring that we're not afraid to take risks where appropriate. So macro worries include both the developed world and the emerging world. US GDP and other data is reasonably positive, but it's still not great. US has got the fiscal cliff to worry about. We've got a slowing of Europe, unsurprisingly perhaps, generally. China still, we've got the question of whether it's going to be a change to a new GDP speed on a sort of structural basis, or if it's just a temporary blip, the GDP slowdown we've seen recently. And aside from that, we've got the big thing to worry about, which is the political risk in Europe. We need to have a solution to Europe's problems, and any which way that unfolds rather, it's going to be a political animal ultimately, and so these things do take a lot of time.
James, thank you very much.
Thanks, Richard.